Hello, everybody, and welcome to this single stock analysis on weBull. weBull, much cheaper than Hood? Question mark. We'll see that at the end of the video. Spoiler, the answer is yes, the stock is much cheaper than Robinhood. So let's first talk about weBull. So weBull is a Robinhood copycat. I'm sure the folks who created weBull might be offended to hear that, but whether it's weBull, eToro, or Moomoo, I'm going to refer to these as kind of like the Robinhood copycats. They do essentially exactly the same thing as Robinhood, and the way they are promoted, unlike Robinhood nowadays Robinhood needs no introduction, but in the earlier days, Robinhood was promoted through word of mouth, through social. This weBull is heavily promoted for social media. Oftentimes you'll see financial YouTubers who are talking about Moomoo or talking about weBull. So that's kind of how they are promoted. weBull grows quite fast. It actually has top-line revenue growth exactly the same as Robinhood, actually, but it is a much smaller company, as we'll see in a second. And so on this channel, we usually don't really have a problem investing in number twos if they are cheap, provided that they are much cheaper. For example, I own LifeMD and I own HIMS, but if LifeMD was the same price as HIMS, I wouldn't want to own LifeMD, right? And so the LifeMD to the HIMS, the Rivian to the Tesla, the Kraken to the Coinbase, and then you have weBull or Moomoo or eToro to Robinhood. These are number two players. These are the challengers. They are much smaller companies, but they are also much cheaper. A few key differences, though. One key difference, and that's kind of like the only, well, I guess there's two differences I was able to see. One of them is you can buy bonds on there, so I don't really know how much business they get from that. But one thing that weBull does right, which Robinhood doesn't do, is OTC. So you have OTC available on weBull, which is a pretty big deal. And they also launched crypto recently to kind of compete with, Moomoo and eToro and Robinhood who have crypto. You can't cater to Gen Z, to millennial investors. You can't cater to them if you don't have crypto. You need to have crypto. They added that. And they also have a nice desktop trading app that a lot of people are happy with, and this is of course similar to Robinhood Legend. I would actually venture out and say that it is Robinhood Legend who kind of copied the trading desks of these different apps. So hopefully that makes some sense. Now you'll see the similarities continue. They have very aggressive offers. In fact, their offer is even more aggressive than Robinhood. If you look at the IRA match, and that's like kind of a big Robinhood innovation, well, they went all the way out to do a 3.5% match. That's like 0.5% more than most employers out there. It's pretty darn outstanding, a 3.5% match that they give you in your IRA up to $8,000. So I think they get a lot of people who are just starting out just for that match. It's a compelling product, much more compelling than Schwab, for example, if you ask me, or Fidelity. I'm talking about platforms whose UI have not changed in decades, right? And of course, weBull, if you read online, it is praised for its user interface, for its user experience. These apps are praised for that. That's why people love them, right? They're app first. They're trading apps first and foremost. They have very low margin rates. These are very comparable to Robinhood. Again, nearly twice as cheap the margin as what you would get on, say, a Schwab, probably in line with Interactive Brokers. So very, very cheap margins. Before I delve into the financials of weBull, we have to address what I'm going to call the elephant in the room. And the elephant in the room is China. weBull, but I will point out that weBull is not the only Robinhood copycat that has gotten the anger of actually the United States Congress, specifically the House Select Committee on Competition between China and the CCP, to be very precise. Moomoo has been targeted too, and if you look at eToro, if you look in the early investors of eToro, I mean that's what they say on Wikipedia, but based on what I see on Wikipedia, eToro also has Chinese roots, or not roots, but Chinese investments or Chinese connection. And that right there, in my view, is an overhang on the stock. It's an overhang on the stock. And you can see when you have senators and when you have a House representative who are calling to protect Americans, right? It's always what they say. They want to protect Americans from the CCP. Well, of course, you have a binary. You have a potentially binary threat. You potentially have a binary threat. Right, this is the same issue as TikTok, and will TikTok be banned in the US or not? This is the same issue as Temu and Shein, and will they be banned in the US or not? I mean, with the de minimis exemption, they removed those, but that's the problem. The impression is that these companies have a pretty big Chinese influence, and for WeBull, I guess to the regulator, it's an easy target because from what I understand, and again, I really don't care too much about drama associated with the origin of a company. That's not my, money is money, investment, companies are companies. So to me, that doesn't really matter. But the company, from what I understand, used to be called Weibo Hunan Weibo. Hunan Weibo, and so they turned it from Weibo to WeBull. At least that's what I'm understanding. And it was founded under Hunan Fumi IT company. It's a Chinese holding company by Wang. So Wang right there founded it, and then they hired Anthony Denier as a CEO, and he's been the CEO since the early days. So it's kind of like a semi-founder led, but not really. I don't really know. But they received backing from Xiaomi, right? Xiaomi is not necessarily a company that the US looks positively on, if you see. So that's an overhang on the stock, and I think that's a big explanation as to why WeBull. But I'm sure if I were to analyze eToro stock, you would find that eToro is also cheap, perhaps for the reason, or at least the perception of the market of these ties. And anyways, it's up to the individual investor to make up their own decisions. Some Chinese backing is very, very high performance. I'll conclude this video talking about me not wanting to invest in a GigaCloud, in GCT, ticker symbol GCT, because of the quote-unquote China association. Well, that was a mistake. Sometimes a China association may mean that the company is going to perform in a very aggressive way. It could mean that, right? It's like, of course, if you look at, say, Temu or Shein, they've been formidable competitors. So it's a double-edged sword. Anyways, let me get to the data, right? The highlights, the numbers. So revenue growth of this company plus 55%. Operating expenses not growing nearly as fast as the revenue growth, so we want to see that. The revenues grow much faster than the expenses, and as a result of that, we have an operating profit. We have adjusted EBITDA. I'll get that at the end of the video. That just got into the positive territory. Now let's talk about the roadmap. Of course, it's a US listed company, which may or may not have a lot of Chinese capital in it, but they are going after the world. They're going after Canada. They're going after global assets, after the EU, after Asia. They're opening that up all over the world. They're introducing crypto. They had removed it. They got it back. They got bonds. I don't know how many customers they're going to get from bonds, but they have bonds. So I guess if people want to buy bonds, they can do that on the app. They have their own AI tool, right? Like Robinhood. Robinhood also has its own AI tool. Cortex is what it's called. They have their premium. They have 90K subscribers to the premium offering. Of course, that's a copycat of Robinhood. Robinhood also has a premium offering called Robinhood Gold, and they just launched prediction markets, just like Robinhood, just like most apps right now are launching, prediction markets, copying the success of Kalshi and the success of Polymarket. Perfect copycat company. They copy real good. That's perfect. And if you look at registered users, plus 17% year over year. So that's actually pretty disappointing if you ask me. But what does that tell you, right? It's just a piece of information that we know. It tells us that the revenue growth is coming from more and more people bringing money to the platform, more and more people using margin from the platform and earning fees from the platform. The existing users use the platform more and more. They don't have an issue of users leaving. In fact, the retention rate, if you round it across the past last 5 quarters, about 98% retention rate. That is a very low churn, if you ask me. That's SaaS level type of churn. That's very low at 98%, very low churn. So this is very good. Customers just use the app more and more and making more and more money. And of course, as they increase their margin, as they, assuming they do such thing, I don't know what they do, but as they trade more fees, more options, etc., they make more money. The revenue growth at weBull is due to the users using the platform more and less due to new users joining the platform. Moving on to customers' assets. So like I said, this is going to detail what I just said. So you have customers' assets. You can see now $21 billion, right? And that's rising with the equity markets who have risen as well. Deposits, new deposits also rising. 2.1 billion net deposits in Q3. So 2 billion were coming in, and that's net deposits. That means that's including the outflows as well. You can see the number of equity owned on the platform. The volume traded on the platform is 204 billion. That's growing as well. They earn fees, they earn spreads every time. And options contracts volume, that's growing as well. They earn fees, they earn spreads every time. And as a result of that, if you look at the breakdown of their revenue, for example, you can see options revenue is where they make a lot of money, but then you have equity revenue, and then you have platform and trading fees where they make the least amount of money. Of course, these companies don't charge $50 for an OTC stock like Schwab does, right? If you bought MetaPlanet, you probably had the sour experience of paying a $50 fee at Schwab for buying MetaPlanet. I wonder what the OTC fee is, but I'm pretty sure it's free or next to free. I'm pretty sure. So, anyways, and if you look at how they've made their income, their interest income on the back end, you can see stock lending, margin financing, client cash, and corporate cash, and that's client cash is the biggest one. But otherwise, the other categories are kind of evenly spread out. So they make money, and they have quite a bit of cash in their balance sheet too, right? So that interest is also pretty darn interesting. So the company under the hood is doing well. If you overlook the potential binary political risk of the CCP rumors, if you overlook that, the company under the hood is doing well, and they're bringing in funds. So the final data that I want to say here, it's founder owned. And is it founder led? It's leader placed. It has a leader placed CEO. Is how I'm going to say it. So I guess I would give him half points, right? It's not founder led, but it's not exactly founder led. So it's kind of a hybrid, okay? And then for shares outstanding and dilution, so I have macro data here. I use macro data. Frankly, this data is spotty. I don't know if I trust it. So I'm just because it looks like they had a lot of dilution in the last quarter, but I don't know if I trust those numbers. So I'm just gonna stay neutral on the dilution. The answer is I haven't looked too much into it. But anyways, the stock is, I have enough data to proceed and tell you what I think. So the data is, the stock is definitely cheap, and it grows just about as fast as Hood, but it is less profitable. Hood, and by the way, they both grow at 42. I just updated these numbers. These are the real numbers. So next 12 months, analysts expect for both of them 42% revenue growth. The big difference is that Robinhood is a much more mature company. They got their expenses way under control, way down, and you can see the Robinhood profitability. EBITDA margin at Robinhood is 52%. Outstanding, right? Profitability at weBull is only 7%, but weBull is decreasing its operating expenses as a percentage of revenue. My guess is that we're going to see, kind of exponential growth in the EBITDA margin number at weBull in the coming years. That would be my guess. And so the rule of 40 over time should go up. But the rule of 40 at weBull right now is a 49. So it is satisfactory. It's good. It's above 40. Enterprise value over gross profit or revenue growth is 0.13. That is very cheap. That is like HIMSS level of cheapness. That is very cheap, especially for that sector when you compare it to peers like, I don't know, Square and the Cash App or Coinbase or Hood. It's an inexpensive stock. Maybe some of that has to do with the Chinese overhang and the potential binary risk of this company having had Chinese investors in the past. This is something for each investor to judge for themselves. And as far as the recent price action, and this is why this stock was a price request, the price action has been nothing but a catastrophe in the short term. It's been a precipitous decline, down nearly 47% for weBull. Wow, that's bad. Down 47%. So is the market exaggerating? Especially given I haven't heard much on the China front, I think the market is entirely exaggerating on this one. And I will caution, and I will finish on this. Is there was a stock that I covered a while back on the channel, which was GigaCloud, that I didn't invest in, I suppose because of the sentiment of the market back then, which was, oh, this company is too associated with China. The association with China is just too strong at GigaCloud technology. Don't touch it. China bad, invest or sell, right? And if you look at this stock, it went on to do a 3x in no time, like in 6 months or something. It did a 3x or something in 6 months. So what I'm trying to say is that the China association, it could be a sign of perhaps political upsetness in the United States, but it could also be a sign of a very ruthless operation on the back end and a very good operator on the back end who works really good at tech, and a lot of Chinese tech is pretty darn good. Look at TikTok, their recommender system, their tools, their apps. The Chinese are great developers and stuff, and so my view is it will come down to this as an investor. Investors need to judge for themselves whether they want to be involved with a company with Chinese capital or not. They need to judge for themselves. And if they want to be involved, then it's important to note that they get this stock for dirt cheap. So to each their own, each can decide. But this stock is cheap. This was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.